Ever wondered where the world's top 0.1%, the heavy-hitting billionaires, actually park their cash? How do they make sure it keeps multiplying, even when the rest of the stock market is absolutely tanking? Welcome to the high-stakes, high-adrenaline, and deeply mysterious world of hedge funds. You won't see flashy commercials for them during the Super Bowl, and for 99% of people, they are completely off limits. But behind the scenes, these funds are moving trillions of dollars. They have the power to shake entire global economies to their core. Today, we're pulling back the curtain, defining the hedge fund. So, what is a hedge fund in plain English? Think of it as an ultra-exclusive private investment club for the mega rich, commanded by the most elite money managers on the planet. Their mission is simple, yet brutal. Grow that capital aggressively using every creative, complex, and high-risk strategy available. Unlike your standard mutual funds, hedge funds don't play by the average Joe rules. They operate with massive flexibility, allowing them to be faster, bolder, and significantly more dangerous. The origin, Alfred Winslow Jones. To understand where we're going, we have to look back to 1949. A man named Alfred Winslow Jones had a light bulb moment that changed finance forever. Instead of just buying stocks and hoping the market would go up, he pioneered a dual-track system. He'd buy stocks he loved, what we call going long, but he'd simultaneously short the stocks he thought were total junk. Shorting is essentially betting against a company. You borrow shares, sell them at a high price, and wait for the company to fail, so you can buy them back for pennies and pocket the difference. By blending these two opposite moves, he created a hedge, a literal financial wall, to protect his portfolio. And just like that, the hedge fund was born. Entry requirements. Not for everyone. Now, don't go reaching for your checkbook just yet. This isn't a game for everyone. To even get a foot in the door, you usually have to be what the SEC calls an accredited investor. In everyday terms, that means you need a net worth of at least $1 million, and that's not counting the house you live in, or a consistent annual income of over $200,000. Why all the red tape? Because hedge funds are far less regulated. The risk of a total wipeout is a very real possibility. If a mutual fund is a safe, reliable family SUV, a hedge fund is a Formula One race car. It's built for insane speed, but one tiny mistake, and it's a total flaming wreck. The inner workings. A top-tier hedge fund is definitely not a one-man show. It's more like a private intelligence agency. At the nerve center, you have the fund managers, the big brains making the multi-million-dollar calls. But they aren't guessing. Surrounding them is a powerhouse team. PhD data scientists digging for hidden patterns, battle-hardened risk managers watching every single cent, and a small army of legal experts making sure they stay just on the right side of the law. The wild strategies hedge funds don't just buy and hold like your grandpa's portfolio. They get incredibly creative. Some play it relatively safe, but others, they go absolutely rogue. They bet against entire national economies. They trade volatile foreign currencies or dump massive capital into alternative assets like rare fine art or even distressed debt. Many now use state-of-the-art supercomputers to execute thousands of trades in a fraction of a blink. Their ultimate goal is absolute return, making a profit whether the market is screaming upward or sliding into a recession. The legendary 2 and 20 fee structure. Here is the real secret to why hedge fund managers are among the wealthiest people on earth. They almost all use the 2 and 20 formula. First, the 2% management fee. If you invest $10 million, They take $200,000 every single year just for keeping the lights on, even if the fund loses money. Then, the 20% performance fee. This is the real kicker. If the fund nets you a $1 million profit, they take a $200,000 slice of that gain as a reward. Critics absolutely bash this model because managers get paid a fortune even when their clients are losing hair. But in the world of high finance, this is the price of admission. The living legends. The history of this industry is written by titans. Ray Dalio of Bridgewater Associates. He runs the largest hedge fund on the planet. His all-weather strategy is legendary, designed to thrive in any economic climate. Jim Simons of Renaissance Technologies, a former Cold War codebreaker. He created the Medallion Fund, which uses pure cold mathematics to solve the market. And George Soros, the man who famously broke the Bank of England. By placing a massive bet that the British pound would collapse, he pocketed over $1 billion in a single day. The epic crashes. But don't let the private jets fool you. With astronomical reward come astronomical risks. Just look at the cautionary tale of long-term capital management. In the mid-90s, they were the darlings of Wall Street. But because they used insane amounts of leverage, playing with borrowed money, they burned through $4.6 billion in just 4 months. The collapse was so big, the Federal Reserve had to step in to prevent a global meltdown. Global impact and ethics. At the end of the day, hedge funds aren't just personal ATM machines for the 1%. They actively shape the world we live in. They can force a global corporation to fire its CEO. They can drive stock prices to the moon or trigger massive layoffs. This leads to a never-ending debate. Are these guys financial geniuses, or are they vulture capitalists profiting from everyone else's pain? Whether you view them as heroes or villains, they are an unstoppable force in modern finance. Whether you love the hustle or hate the greed, hedge funds are the ultimate power players. But if you aren't a billionaire yet, don't sweat it. The best investment you can make is in your own knowledge. So keep learning, hit subscribe, and stay tuned. Maybe one day you'll be the one cutting that check. Peace.